Hi, this is Kerry Artek with Wicked Stocks, bringing you your daily Tesla report for Tuesday, February 6th, 2024.
But before I walk you through the charts, as usual, just want to encourage you to please click like if you haven't already, subscribe to the Wicked Stocks YouTube channel, share the content if you would with friends and colleagues, and check out wickedstocks.com, where we offer a full suite of both daily and weekly analytical videos just like this one. Daily analysis in the SPY and the Triple Q, that is the S&P 500 and NASDAQ 100 ETFs. Weekly analysis in the S&P 500 Index, the NASDAQ 100 Index, the Long Bond ETF, the TLT, as well as 2 individual stock picks a week that you never see on YouTube. That is 8 a month that cater to the 3 to 5 week swing trader out to the 3 to 5 month near-term investor. We're always looking for at least 20% moves on those stock picks, and you can check out all of this for no cost for 5 days. We offer a 5-day free trial up front with a wickedstocks.com subscription. So sign up for wickedstocks.com, check it all out. If you don't like what you see within 5 days, you can cancel your subscription at no cost to you whatsoever.
Let's take a look at the charts. Well, Monday was the day that we essentially tested our 173.28 channel bottom. Now, we definitely tested the 177 and a quarter 5/8 downside Fibonacci from the January low of last year against the more recent July high. And we did essentially test 173.28 because we dropped to the 1% mark. In fact, to the very tick. 175.01 is 1% above 173.28. So I'm going to call this a test. And if you've been short the entire time from the 258.13 channel top, bravo. We've been mentioning how after testing that targeted 258.13 channel top, that the market was susceptible to rotating back within 3 to 5 months to the channel bottom. That is at 173.28 this week. And it took about 6 weeks for that to occur. So in about half the time that we had anticipated, on the way down, we did have a clarifying sell signal about 3-4 weeks ago when we closed below this. This is the daily chart, by the way, a combination rising channel bottom and 2/3 speed line that is presently well above the market in the lower 230s. And so 174.12 is the channel bottom on the daily chart. Just make a note. I do still show this as a rough 4-point range that begins at 177 and a quarter, the 5/8 downside Fibonacci. This is your bottom picking territory, whether you're covering short positions you've been holding for days or weeks, or whether you're actually going long. Because as we slip into this area, I'm now talking about the possibility that over the next 3 to 5 months we can rotate upward to the 258.13 descending channel top. Now, it's not clearly indicated. It's not what I would call expected. But if there's anything to do for 3 to 5 month investors, 2 to 3 month investors, or you could call those longer term speculators, it would be to get long in this 173.28 to 177 and a quarter region in anticipation of the 258.13 channel top, which is dropping at the same rate. And that is really what's in play now, is recovery back into the 250s and dropping as we move really through the second quarter, into and through the second quarter. Now, what is the clarifying buy signal right now would be a settlement in the coming weeks above 215.80. And so this is our 3 to 5 week time horizon. So some of you like to trade 3 to 5 months out. Others are 3 to 5 weeks, roughly. I'm not saying that's your exact time horizon, but that's the way I kind of break the market down. So as we're slipping into this mid to upper 170 support, which we did on Monday, you could consider reaching for, say, I don't know, 210 strike out of the money calls that don't expire for at least, I'd go 2 months out on that, even though I think this move is about 3 to 5 weeks. And I say 210 because 215.80 is dropping on a daily basis. It is a new descending 1/3 speed line, trend defining in its own right, projected off that July 23 high, and using the low that was put out on Monday as the basis. So that 215.58, if you were to go back to Monday, it intersects exactly, that line does, with the 1/3 0.333% upside retracement from the July high against yesterday's low. That is the 3 to 5 week time frame. So if you're buying Tesla and you like to hold stocks for a month or so, you can do so. up to the 215.80 descending speed line, and we'll be apprising you of its location as we move through time. Now for the day itself, I don't know if we'll test 192.74. I do think if we push through Monday's high of 184.68, which you can see in the support resistance area, it offers pivot point qualities because it is a move low. It's the lowest this market has been since that July high. And so if we push or open today above Monday's 184.68 high, you should allow 192.74 on an intraday basis where we can place a daily high. I also have an up pivot point next to 192.74. And I'll also say that 192.74 just might contain buying through the rest of the week. So we could fall Wednesday, Thursday, Friday back into the mid 170s following a test of 192.74. In fact, these two levels, a 174.12 on the daily chart and 192.74 above, are what I would consider the 3 to 5 day swing traders extremes. These are the levels to trade, buying 174.12, selling 192.74 thereabouts on a 3 to 5 day basis. If we close today above 192.74, I think we've got a good February low. I think within a matter of 2 to 3 days or so, we should reach 202.62, which is a descending one-third speed line projected off that late December, early January high. But really, I think if we do close above 192.74, and you're kind of a 1 to 2 week swing trader, it is go long up to 215.80 with a hesitation expected. Possibly for a day or more at 202.62. But I do see that the settlement above 192.74 indicating 215.80 sooner than the 3 to 5 weeks that I mentioned earlier, more like a couple of weeks, the better part of 2 weeks. 215.80 can absorb buying through March trade, for instance, or perhaps once we test 215.80, we can fall away back to the mid 170s within 3 to 5 weeks. We could fill out the 174.12, the 215.80 gradually narrowing wedge for the next couple of months, perhaps. But overall, I will say once again that holding above 173.28, now that we've tested it, will keep 258.13 in reach over the next 3 to 5 months or sooner. And so you can act on that. You can prepare on that. And then closing, of course, above that 215.80 speed line is the clarifier. Within another 3 to 5 weeks, we should then reach that low 250s resistance at 258.13 and dropping. I say low 250s because over the next few weeks, it will be low 250s. Let's talk downside today. I don't expect to see it. In fact, I'm just going to jump right to the sell signal that would occur if we close below 173.28. Now, it could happen today, but I still want to honor, even on an intra-week basis, the 171.54 1% violation threshold. In other words, if we are to continue south into the 101.81 to 103.71 region over the next few months, it would be a settlement on Friday at 171.54 or lower. That is a 1% violation to the downside of the 173.28 channel bottom. You can use 171.54 on an intraday basis for day traders. It could be your stop out below 171.54. So if you buy 173.28, you could put your stop below 171.54. I think that's a pretty decent trade. But if we close today at 171.54 or lower, I would expect 163.91 within a couple of days. And then, of course, overall, a Friday settlement at 171.54 or lower, 1% below that 173.28 channel bottom, does set up another 2 to 3 month sell signal into the very low 100 area. So if you reach for those 210 calls or those 250 calls that I mentioned earlier in this video as kind of a near to midterm upside projection, you'd want to liquidate those and in turn reach for 102, 103 strike out of the money puts that don't expire. This could take 3 months. It could also take 3 weeks, but it's probably closer to the latter. So I would go 6 months out on the expiration. If you're to reach for 102 strike out of the money calls or puts rather, I would go 6 months out on expiration just to preserve delta on the way down, reduce the time decay element. The last thing that, what's the most frustrating thing that I've learned over the years, if you reach for the right strike, but you got the wrong timing. There's nothing more frustrating than watching the market approach your strike after days and weeks of waiting only to see it expire to almost absolutely nothing. So picking the right expiration is key. I think that pretty much sums it up for the day. So I'm going to leave it at that for Tuesday's Tesla. Please click like, share, subscribe, and check out wickedstocks.com for that 5-day free trial. I'll be back tomorrow with Wednesday's Tesla. You have a great day.